Hello and welcome to this video where we are going to reveal the shocking truth about insurance companies that they don't want you to know. Insurance is something that we all need at some point in our lives, but do you ever wonder why insurance companies are always trying to sell you more coverage? Let's find out what they are hiding from you. Insurance companies are for-profit businesses. Insurance companies are not charities. They are for-profit businesses that are in the business of making money. Their primary goal is to maximize their profits, not to help you in your time of need. Therefore, they may try to minimize the amount of money they pay out in claims or raise premiums to increase their profits. Insurance companies use complex language to confuse you. Insurance policies are full of complex terms and jargon that can be difficult to understand. This can make it challenging for consumers to know exactly what they are paying for. Insurance companies often use this to their advantage by burying important information in the fine print or using complex language to confuse customers. Insurance companies may try to deny your claim. Insurance companies may try to deny your claim for any number of reasons. They may argue that the damage was caused by a pre-existing condition or that the claim falls outside of your policy's coverage. Insurance companies may also try to delay or deny your claim in the hopes that you will give up and go away. Insurance companies may charge you more based on personal characteristics. Insurance companies may use personal characteristics such as age, gender, and location to determine your premiums. For example, if you are a young male driver, you may be charged more for car insurance than an older female driver. These factors may not necessarily be related to your actual risk of making a claim, but insurance companies use them to justify higher premiums. Insurance companies may have conflicts of interest. Insurance companies may have conflicts of interest that could impact the way they handle your claims. For example, if an insurance company owns a body shop, they may recommend that you get your car repaired at their shop even if there are other options available that may be more affordable or offer better service. Insurance companies may use scare tactics to sell you more coverage. Insurance companies may use scare tactics to sell you more coverage than you actually need. For example, they may tell you that you need comprehensive coverage to protect against natural disasters, even if you live in an area where these types of events are rare. Insurance companies may use your personal information against you. Insurance companies collect a lot of personal information about their customers, such as their credit score, driving record, and medical history. While this information may be used to determine your premiums, it could also be used against you in other ways. For example, an insurance company may deny you coverage if they discover that you have a pre-existing condition that could lead to costly medical bills. Insurance companies may have higher deductibles than necessary. An insurance deductible is the amount of money you have to pay out of pocket before your insurance policy kicks in. Insurance companies may set higher deductibles than necessary to reduce their risk and lower their costs. However, this can also result in higher out-of-pocket expenses for you. Insurance companies may offer inadequate coverage. Insurance companies may offer inadequate coverage for certain types of losses or damages. For example, your homeowner's insurance policy may not cover damage caused by floods or earthquakes, which can be costly to repair. Insurance companies may use third-party adjusters. Insurance companies may use third-party adjusters to evaluate your claim. These adjusters may have a conflict of interest, as they may be paid by the insurance company to minimize the amount of money paid out in claims. Insurance companies may have exclusions in their policies. Insurance policies may contain exclusions that limit coverage for certain events or types of damage. For example, some auto insurance policies may exclude coverage for accidents that occur while the driver is under the influence of drugs or alcohol. Insurance companies may use arbitration clauses. Insurance policies may contain arbitration clauses, which require customers to settle disputes through arbitration rather than through the court system. This can limit your ability to seek recourse in the event that the insurance company denies your claim or engages in unfair practices. Insurance companies may engage in bad faith practices. Insurance companies may engage in bad faith practices, which involve denying legitimate claims or delaying payments without a valid reason. This can have serious consequences for policyholders, as they may be left without the financial resources they need to recover from a loss or damage. Insurance companies may offer misleading discounts. Insurance companies may offer discounts for certain types of policies or coverage, but these discounts may not always be as significant as they seem. For example, an insurance company may offer a discount for bundling home and auto insurance, but the savings may not be substantial enough to justify the added cost of the extra coverage. Insurance companies may use different rating systems. Insurance companies may use different rating systems to determine premiums for different types of policies. This can make it difficult for consumers to compare policies and find the best rates. It is important to shop around and compare quotes from multiple insurance companies to ensure that you are getting the best value for your money. Insurance companies may have limited liability. Insurance policies may have limits on the amount of money that can be paid out for certain types of claims. For example, your homeowner's insurance policy may have a limit on the amount of money that can be paid out for damage caused by water leaks or mold. It is important to understand these limits and make sure that you have adequate coverage for your needs. Insurance companies may use credit scores to determine rates. Insurance companies may use credit scores to determine rates for certain types of policies, such as auto insurance. This can be problematic for consumers who have a poor credit history, as they may be charged higher rates even if they have a clean driving record. Insurance companies may require extensive documentation. Insurance companies may require extensive documentation before paying out a claim. This can be time-consuming and frustrating for policyholders who are already dealing with the stress of a loss or damage. It is important to keep detailed records and document as much as possible to ensure that you have the information you need to file a claim. Insurance companies may have different types of policies. Insurance companies may offer different types of policies for different types of coverage. For example, auto insurance policies may offer liability coverage, collision coverage, and comprehensive coverage. It is important to understand the differences between these types of policies and make sure that you have the coverage you need. Insurance companies may use different methods to determine risk. Insurance companies may use different methods to determine the risk of insuring a particular individual or property. For example, they may use actuarial tables, statistical models, or predictive analytics to assess risk. It is important to understand how insurance companies determine risk and how this may impact your premiums and coverage. Insurance companies may offer different levels of customer service. Insurance companies may offer different levels of customer service, depending on their size, resources, and reputation. It is important to research the customer service ratings and reviews of different insurance companies before choosing a policy. This can help you avoid companies that have a history of poor customer service or claims handling. Insurance companies may offer discounts for certain groups. Insurance companies may offer discounts for certain groups, such as military personnel, seniors, or members of certain organizations. It is important to check for these discounts and make sure that you are taking advantage of any savings that may be available to you. Insurance companies may offer different payment options. Insurance companies may offer different payment options, such as monthly, quarterly, or annual payments. It is important to understand the costs and benefits of these different payment options and choose the one that works best for your budget and financial situation. Insurance companies may have different cancellation policies. Insurance companies may have different cancellation policies, which can impact your ability to switch policies or providers. It is important to understand the terms of your policy and the consequences of canceling or switching before making any changes. Conclusion. In conclusion, insurance companies are not always as transparent as they should be, and they may not have your best interests at heart. It is important to educate yourself about your insurance policies and read the fine print carefully. Don't be afraid to ask questions or shop around for the best rates and coverage. Remember, you have the right to hold your insurance company accountable and demand fair treatment. Thank you for watching this video, and we hope you found it informative. Subscribe and like this video so that you will not miss the next video. Comment down below today.